So I mentioned in my tutorials today that the first 4 weeks of auditing are the hardest, all right? Because the learning curve of what you've got to figure out looks a little bit like this, all right? So, you know, this is time, T down here, and this is L for learning, all right? So the learning curve for auditing over the first 4 weeks is steep. It's really, really, really hard because we're learning all this new terminology, and then it starts to actually level out a bit before it kicks up a little bit at the end of the term. Just to make sure that you're not complacent, all right? So if you can get through the first 4 weeks, you should be good for the rest of the semester. Just keep on plugging away at it. But so far, from what I've seen from everybody, I'm super impressed. I'm really impressed with what I'm seeing in the classes in terms of how you're scoring individually in the quizzes. But more excitingly, students really seem to be working together in the group component or the team component. You might be wondering what we're doing in the third part of the tute where we usually do an exercise. There, I am training you to do the final exam, all right? Because the final exam will be case-based information. It'll be thinking on your feet. It'll be coming up with answers to questions that don't necessarily have answers in books, where you need to figure it out on the spot. So that third part of the class, you don't have to stay for. All right, it's not compulsory, but I recommend that you do because it's all about preparing you for completing that final assessment. And I want everybody to do really well. All right, that's my goal, is for everyone to do really well. So we've done the first quiz and I've seen all those lovely words. I'll make a little word cloud, actual word cloud thing out of it, and I'll post that on social media. But let's do our concept map, right? So for those people who might not have been here last week, I started with this idea of concept maps, of trying to figure out what we know so far and what we don't know. And when you look at this one that we're going to draw today and what we draw in week 11, you'll be really surprised at what we do and don't know about auditing. Okay, so let's start with some basics. We know that I have to generate an audit report, okay? I know that my auditors have legal liability as a result of issuing that report, all right? And that legal liability comes from different sources. It comes from regulation and legislation. Can I ask somebody who's up the back to see if we can shut that back door, just so we don't get too much noise? Okay. We know that legal liability also comes from the tort of negligence. Let's shrink that down a bit because I'm going to run out of space. And we also know there's one other place where law comes from, legal liability comes from. Anyone remember? Contract law. Excellent. Okay. I'm going to draw lines on all of these a little bit later. These diagrams never look pretty. Okay, so we have our audit report, our legal liability. We know that the auditor needs to be independent to be able to give the audit report, and that independence also comes from our regulation related to auditing standards. Okay, I'm going to draw some lines here so that we don't get confused. All right, so the audit report creates legal liability, and we're legally liable from these 3 areas. I need to be independent to be able to generate my audit report, and that independence comes from APES 110, and it also comes from the Corporations Act in terms of my regulation and legislation. All right, so I'm going to add a little thing there. Corps. And obviously we have students from all around the world that watch our lecture videos, but this is just for those people here in Australia. Okay, so I have my audit, I have my audit report. I know that my audit report is on the financial statements. All right, and it's management's job to actually prepare those financial statements. Let's just make that a bit smaller. Okay, so audit report on the financial statements. I have to prepare my financial statements in accordance with my AASBs, because those are my legally enforceable standards. All right, and that I have to do my audits in accordance with my ASAs. Okay, so the audit report is prepared in accordance with the ASAs, which also come from the Corporations Act. And the ASAs also tell me that I have to be independent. All right. So that's sort of where we're at. We know that the audit is about making sure that we have the truth in the financial statements. So it's about finding the truth of this. But there's a big question that we haven't covered yet. And that's how. All right, how does any of this process happen? From deciding to do an audit to generating our audit report, what's the process? So today is the start of the how. Okay, today is the start of gathering all of our technical skills. All right. And one of the key things that I'm always going to focus on is making sure that you understand why auditors do what they do. Because clients change, situations change, and if you're just blindly following instructions from whatever some senior auditor has told you, if you don't understand the situation really well, then you could expose yourself to some legal liability. All right. Anybody here an audit trainee or cadet? A few people? And how often do you just get told to do something and you don't know what you're doing? Like, get these documents, match this number to this number. You're like, well, why exactly am I doing that? So I think it's a really important foundation of why we do auditing to be able to then do the actual how. And we're going to do that in the term. We're going to do some actual audit tasks. I won't make you go out there and collect a sample of 500 invoices. But we will do some actual audit tasks in the subject. Just do a little. All right. We have lots of objectives this week. There's huge numbers of objectives. Let me just change the color of my pen here. Okay. So we're going to look at why we do our audits. Let me make that a bit more opaque. I don't like that. We're going to look at what's management's responsibilities, because some stuff is the auditor's responsibility, some stuff is the auditor's. We're going to look at what our responsibility is. We're going to look at the transactions and account balances that make up the financial statements, how we actually generate assurance. We're going to look at a word called assertions. We're going to develop some audit objectives for classes of transactions, which is going to be things on the income statement, for balances, which are obviously things on the balance sheet, and for presentation and disclosure. And then we're also going to look at some basic concepts about audit evidence. So this is really the initial planning stage, a general understanding of audits. Next week we're going to get into planning, and we're going to look at what we need to consider in a client before we actually jump in. Now, one thing I think I didn't talk about last week, but I will right now, I'm going to add an extra slide for this, is I'm quickly going to talk about different audit opinions, because I like to cover this up front, even though the opinion is the last part of the audit. So the audit opinion will fall into one of generally two categories: unqualified, all right, and the unqualified opinion is essentially the opinion that you get when you give the client a big tick. Everything is true and fair. All right, so here we're saying everything is fairly stated, all right, in both the numbers and the note disclosures for the financial statements. Okay, now the other option that we have is that we have modified audit opinions. And this is where it gets a little bit more complicated, because undo. Modified opinions actually fall into 3 different categories. All right, I'll put those up and then I'll talk about each of them. We've got qualified, adverse, and limitations. Oh, hang on, no, I'll reword that. Disclaimer. Okay. All right, so I'm going to talk about the end product because it'll come up throughout the semester. So a disclaimer of opinion, I'm going to start with the worst, I suppose, at the end. So the disclaimer of opinion is the opinion that you have when you're giving no opinion. You're saying when you give a disclaimer, I cannot get sufficient evidence to actually be able to generate an opinion for you. There's not enough evidence, I can't get it, it's not reliable, some reason. The next one, which is the adverse, is that we think there are multiple reasons management isn't being truthful or evidence is not available. All right. So that's the adverse. And the diagram I always put with this is this one. And you'll have to, excuse my arts and crafts. All right, so what's that? Octopus, fantastic, thank goodness. Phew. All right, I'm not going to change to design and architecture and the arts faculty anytime soon. But there are multiple reasons. So think about the octopus. There's lots of different tentacles, which means there's lots of different reasons why things are not right. All right, and the one after that, or the one before that, is qualified. So there's a small reason management isn't being truthful or is missing evidence. All right. And there's no such thing as a small octopus. I suppose you could draw a fish for the qualified one. But in all of these instances where I give a modified opinion, that is a big signal there that something is not true and fair within the financial statements. Okay. So we'll mostly talk about unqualified. This is the gold standard. This is what everybody wants for their financial statements. You get one of these, then your share price is not going to look pretty. All right. So in the instance of one of these, especially one of those ones on the right-hand side, if this is time and this is the price of your shares, then you can expect this pretty quickly because shareholders know that you're not being truthful about something. And what auditors do is they actually tell the shareholders, oh look, management are not being truthful about sales, overstated by 250 million. Or they're refusing to disclose information on third parties. All right. So those are the basics of our audit opinions. If you're interested, I'll link you guys up with a video that goes through all of them. But just know these basics for now. Okay, so our first objective, what is an audit? And I've actually taken this excerpt straight out of ASA 200.3. So if you've not looked at a standard in a long time, standard number. All the numbers in the 200s are all about the planning and early stage part of the audit. And then the dot, and then the 3 means the paragraph. So I'm going to use my highlighter here to highlight bits that are important for us. All right, so let's look at these here. The purpose of an audit is to enhance the degree of confidence of intended users of the financial report. Now, who are the intended users? Shareholders. Fantastic. All right, so my intended users are those shareholders just there. Okay. It is achieved by expressing an opinion, which we just looked at, the opinions, on whether the financial report is prepared in all material respects in accordance with the financial reporting framework. What's our financial reporting framework? AASBs. Excellent, thank you to that person. So financial reporting framework is our AASBs. Okay. Our opinion on whether the financial report is presented fairly in all material respects gives a true and fair view. An audit must be conducted in accordance with the auditing standards, which we know are our ASAs. ASAs. And also our relevant ethical requirements, which is APES 110. All right, so that's the basic objective of our audit. We're trying to improve the confidence and reliability of the information that shareholders are going to use and make sure that we're following our financial reporting framework. All right, so here are our audit objectives. We need to understand what we want to do on the audit, divide our company into the financial statements into different processes or cycles, which we're going to look at. We're going to learn about what assertions are, because that's probably not a word we've heard about before, generate some audit objectives, and then specific objectives for individual accounts. So we have a top-down approach. We start by looking at the client as a whole, then drill down a lot further. And that's what we'll be doing over the entire audit. All right. Now, obviously, one of the objectives, well, these are developing the objectives. After this, we go to a process of collecting evidence, all right, and then generating our opinion. Okay. All right, so who is responsible for preparing the financial statements? And quite often, public misconception is that they think that it is actually the auditor's job. Oh, isn't the auditor's job to go out and prepare the financial statements? That is actually management's responsibility, and that responsibility is actually detailed in the Corporations Act 2001. I should do the proper full process there. But the Corporations Act says it is management's responsibility to adopt sound accounting policies, choose the right policies for the right situation. And you would have looked at that when you studied your accounting standards and regulations subject with probably Rob. Did you guys have Rob and Dave? Yep, Dave with the big beard, little Rob. Of course, future students will have Dr. Helen now, but we want to choose the right accounting policies, have good internal controls, good policies and procedures to make sure that people are doing the right thing. All right, and we learn a little bit about policies and procedures a bit in MDC, okay? With, I think, who's doing MDC this semester? So, not many. Hands up who's doing FSA. So there's very few people doing what we call the Bermuda Triangle, which is FSA, MDC, and auditing at the same time. That's the trinity of pain right there, those three. We don't recommend students do all three at the same time. So our goal, a management's goal, is to make fair representations in the financial statements. The Corporations Act says, management, you should try and be truthful. But just in case you're not truthful, we're going to have the auditor come in as an independent third party and do a check. The Corporations Act is so serious about making sure that management are aware that they are ultimately responsible for what goes into the financial statements, that the Corporations Act requires them to prepare a declaration. And this actually goes in, and you'll see this in the annual report. All right. Again, when they sign their name down here, it reminds them that this is their personal responsibility. Okay, so Corporations Act, oh, I can see it's actually just highlighted right there. Corporations Act says, this is our particular responsibility, we've complied with the accounting standards, and there are reasonable grounds to believe that we will be able to pay their debts when they become due. Does anyone know what that concept is called? It's solvency. There's also another word. It's two words, actually. There's two words. No? Starts with G. Going concern. Who was that? All right. Remind me, I will bring a chocolate for you next week. All right. We had leftover chocolates from doing the in-class first week thing, so I've got some spares. Okay. So we are going to also, make sure that our clients are a going concern. So as well as our responsibilities to check that the financial statements are a true representation of what actually happened, I'm also required to check that management are correct in their assessment that the company is a going concern. Okay, so what is my job for discovering something called material misstatements? And the idea of this word is probably not something that we've really come up against before. Okay, so, I didn't tell you what ASA this is from. So the objectives of an audit, this also comes from ASA 200, paragraph 11 there. So in conducting the audit of the report, the objectives of the auditor are, and let's quickly go through these. Reasonable assurance. We know about reasonable assurance, not a guarantee, about whether the financial report as a whole is free from something that we call material misstatements. Whether due to fraud or error, and remember last week we looked at fraud or error in regards to, ASA 240. All right, and our responsibilities to search for fraud, watchdog, not a bloodhound, Kingston cotton mill, etc. And we're going to express an opinion about whether the financial report is prepared in accordance with the applicable financial reporting framework. So we've done the applicable financial reporting framework again, but I'll put that there just in case. So we know our applicable financial reporting framework. We know about fraud relating to ASA 240. We talked a little bit about our responsibilities last week, but I'm going to delve into it a bit more. But then we also need to look at this idea of what the heck is a material misstatement. All right. So I've just given you a new question on learning catalytics. What do you think materiality means? A, it has something to do with fabric or material. B, it means something composed of matter. Or C, it is something relevant or important. Let's see what we come up with. Well, so far, most people think C, that's good. And, I got these definitions from the dictionary. So I went to the dictionary.com and I said, materiality. What does materiality mean? Well, oh, look, who picked B? All right, so we got B's. Nobody thinks A yet. Something to, it could be to do with how well the auditor is dressed, perhaps. Well, I think we had 60-something people answer the previous question, so we're almost there. So our learning catalytics, the correct answer is C. Something that is relevant or important. So what we're looking for in this idea here is relevant or important errors in the financial statements. Okay, oops, let me make that a bit smaller. All right, so the idea of something being material is it's relevant or important. how am I going to figure out, oh yay, somebody thought fabric. So how am I going to figure out what's relevant and important? You could be cause and effect. Yep, I'm going to write these down. So what could be relevant or important could be, I'll just make the font smaller. It could be, the cause, the effect. Any other ideas on what materiality could be? It could have a big impact. What else? You're looking through your credit card. You're looking for unusual transactions. Are you more likely to look for big ones or small ones? Big ones, potentially. So it could be dollar value. All right. Or it could be impact. Okay, so materiality could be any of those things. And when we think about materiality from the auditor's perspective, we think about which adjustments or changes to the financial statements would be important to our shareholders as decision makers. And so there we do think about the cause and the effect, which are sort of related to the impact and the dollar value. So I'm certainly looking for bigger errors rather than smaller errors. That means on the audit, because I'm only looking for material misstatements, I'm not really worried about employees that might steal a packet of Post-it notes, or if you've taken one pen home out of stationery. I'm not looking for those. I'm looking for the accountant who's stolen $10 million out of cash, all right? Or someone who's managed to smuggle out 100 iPhones from the iPhone factory and has flogged them off on eBay. So I'm looking for ones that are relevant or important. So what are my responsibilities? I have a responsibility, and this is from an old document in 2013, to engage in what we call professional skepticism. I'm going to highlight that in yellow, I guess. Let's try that. All right. And professional skepticism means that I'm taking an attitude of making sure that I'm critically assessing the work that I'm looking at. Right? I don't just take people at their word. It doesn't mean that I'm, X-Files conspiracy theorist skeptical. It means that I look at all the evidence and I say, well, does this seem reasonable? Does this electricity bill from Origin Energy look similar to the electricity bills I might get at home? Right? In the layout, the paper. I once had a student submit to me an application for special consideration, and it was all filled out appropriately, doctor's scrawly handwriting. And then I noticed, the doctors usually put their stamp that has their Medicare provider number on the bottom of the form. And I looked at the stamp, and as I was turning over the paper, what happens when you stamp a piece of paper with an ink stamp? It usually bleeds through on the other side. And as I was thinking, oh, this looks okay, and I turned the paper over, I noticed there was no bleed through of the ink on the other side. So that little piece of evidence made me a little bit skeptical. I thought, oh, what's going on here? I turned it back over, I looked at it more closely, and it turns out the student had obviously used Photoshop or something similar to take a previous copy of a doctor's stamp and then place it on his application. All right? We found out that the doctor who stamped it had stamped an application for this student years ago, and then instead he just filled out the writing. So when we're looking at evidence, we're being skeptical. We're saying, does this seem reasonable? Does this look appropriate for what we're doing at that point in time? Does it seem appropriate? And this happened at a mining firm of a colleague of mine in Canada. He noticed that a guy who handled site construction for a mining firm earned 5 times more than the CEO. What? Why does this guy earn so much money? They just downloaded the payroll, annual salaries, a wage expense, had it by person, sorted it just so they could look at the biggest salaries versus the smallest ones, and they saw the guy and, who's this guy with the biggest salary? He's not the CEO. Investigate some more. Turns out, and when they questioned this guy, he is the guy responsible for paying bribes to help progress construction projects in countries where bribery is required. So they were involved in some mining activities in South America where, as part of the regular business process, you'd need to make a donation to the mayor's campaign or a donation to the police fund for something. And they confronted him and said, oh yeah, I'm the guy that pays the bribes. So the company legally recognises my entire wage as an expense. They pay tax, all the rest of it, and then he uses that money to dole out bribes to other people. Which I wasn't quite sure, I'm looking at the relevant accounting standards in Canada going, I'm not sure where this fits. Is this a valid expense? There's no line for bribery expense, unfortunately, in the income statement. So we need to have this idea of professional skepticism. So my job is to collect and evaluate evidence, but I cannot force management to do anything. All right? So I have to have a questioning mind, being alert to anything that might indicate a possible misstatement. And this is where I think sometimes audit firms take a big risk in telling junior auditors to just do X procedure without giving them the full context of why they're doing it and what they might be looking for, because they might miss something. Obviously, you have seniors reviewing that work, but it's sort of a little bit better if everybody is in on the game. So I'm always taking what we call now a holistic view of the company. I need to understand my client. I need to know what they're making, how they make it, who's involved, so that when I'm looking at evidence, I can go, well, hang on a second. The company manufactures products in the Philippines, but they import some sort of raw material from Russia when I could buy it from Indonesia for much cheaper. Why do they do that? We have that might lead to a related party transaction that perhaps they're not disclosing. So we're always trying to be professionally skeptical as part of our responsibilities. That's part of what I'm going to be teaching you guys about. So I plan my audit and performs an audit to detect unintentional mistakes. The one where you are typing and you get the numbers around the wrong way, or you type an extra zero. And I find errors, usually from mistakes in calculations, forgetting to do something. I went on holidays for a month and I forgot to process a whole lot of transactions. A misunderstanding in how something should be recorded, a misapplication of my accounting standards, or an incorrect summary. Less than 5% of auditors actually ever find fraud. So we have these ideas in ASA 240 about what to look for, but a very small proportion of auditors actually ever find fraud. Usually it's quite small stuff. People maybe double recording transactions or creating fake suppliers, but often auditors don't detect the really complex frauds. Or if they do, like at Enron, they know about it and they cover it up and they're in trouble. So what are my responsibilities? And we've looked at ASA 240 before. Oops, I'm going to change my colour. Let's go green. Oh, undo. Okay. So we looked at Kingston Cotton Mill last week. And we should remember Kingston Cotton Mill had a little dog analogy. Kingston Cotton Mill said, auditor is a watchdog, not a bloodhound. Okay, watchdog, not a bloodhound. Okay, so that's my role as the auditor. And there are two characteristics, or there's often three. This particular slide has two, but I'm going to put something on the next slide. There's usually some sort of pressure or incentive to commit the fraud or a perceived opportunity. So I'm going to go to ASA 240 here. because the textbook has those two, but the ASA takes it one step further. So it says that we have an incentive or pressure. I'm going to talk about each of these in a second. An opportunity or a rationalisation or attitude to conduct fraud. And I'll just add those to my fraud triangle up here. All right, so incentive or pressure. All right. So there will be the possibility of an incentive for fraud. Is there some sort of bonus scheme or something that encourages people to perhaps be less truthful? Is somebody addicted to gambling or the pokies, and so that's why they're stealing money from the organisation? What is their incentive? It could be even to look good against other companies. Right? So management have their own incentives from an executive level to outperform another company or beat an analyst benchmark or perform better than they did last year, especially if they had a loss the previous year. So in companies, people have incentives, and there's lots of incentives to commit fraud. The second one is there has to be an opportunity. Is there some way for people to conduct fraud and get away with it, not get caught? Could there be a policy or procedure that's missing? All right. Before we used to actually bolt computers into these big desk-like barbecue things, they used to go missing all the time. People used to come into the university on weekends dressed in sort of like workman's overalls and carry ladders, and they'd walk into lecture theatres like these, put a ladder up, unscrew a data projector. People say, oh, what are you doing? Oh, look, I'm here to officially service these items. And then they'd just be stolen. So is there an opportunity to commit fraud? And then the last one there, is there an attitude or rationalisation? Okay, and so what is the employee's attitudes towards fraud and management's attitudes? So if management are like, oh, we're not the actual people that own the company, we're just the employees, so let's maximise our own wealth by perhaps creating fake customers and recording fake sales so I can get a bonus, because I'm not a shareholder and that doesn't bother me. So they could have an attitude or a rationalisation. So often employees that engage in theft over long periods of time say something like, well, I missed a promotion the last 2 years. Right? They always gave the promotion to someone else. I deserve this. I've worked hard for this company for 25 years and I'm still at a junior level management position. I am taking what I deserve. Or the attitude is the company can afford it. Our company made $200 million profit this year. They can afford for me to steal some inventory or to steal a little bit of cash. All right. So there can be a lot of unusual attitude. I saw it a lot. So when I was auditing at PwC, I audited a lot of financial services institutions. And, a lot of times money is just numbers on a computer. They're like, well, the bank is insured. So if I steal money, the bank realises money is missing, they have insurance for that. So therefore, I should be able to get away with it. I used to audit also a lot of government organisations where people would say, I'm a taxpayer. So therefore, that gives me a right to take home excessive amounts of stationery or a photocopier or a printer or something else. So we're always looking out when we're going to speak to our clients, do we see any incentives or pressures? Are there any opportunities? Do I see any places as part of my role as a watchdog where there could be fraud? Or do people have an attitude about getting away with it? Or everybody is doing it. Everybody takes home, something off the production line. If everybody's doing it, why shouldn't I do it? That sort of group idea, that pack mentality of even if everybody's doing the wrong thing, as long as we're doing it all together, that's okay. So the fraud triangle is quite important in terms of our responsibilities as an auditor. We are looking for any one of these things. It doesn't have to be 3. It could be one of these things that could drive fraud. So what are my responsibilities for detecting illegal acts? Direct illegal acts, we have a responsibility to investigate and detect. indirect illegal acts, not legally our responsibility, but something worth thinking about doing. Okay, so let's go to our third learning catalytics question. Oh, no longer active. Oh, hang on a second. Well, I will fix whatever I've just buggered up. Okay. All right. So, if the auditor is required to investigate and gather evidence of an illegal act if it's suspected, which is what I've said here, if illegal acts are found, who should the auditor communicate with? The management of the client, CEO, CFO, etc., the audit partner, the board of directors, or the audit committee. And you can select none, one, or multiple answers here. All right, so while you're doing your quiz, I'm just going to check how everybody's going on their responses. All right, so we've got 15 people who've responded to their question so far. I know we've got about 60 people here today, so I'll give it another minute or two. So why wouldn't we want to tell the management of the client, the CEO or the CFO? They might be involved, exactly. All right, so if they're in on it, even if early you might suspect it's someone lower, but someone higher up might be getting a proportion or a cut, you don't want to spook the client by telling them too early, especially if it's a CEO or CFO. So you want to talk to the audit partner, right? The audit partner will call in a forensic auditing specialist, a fraud specialist, to come in, because the way we train auditors and the way we train fraud specialists is a little bit different. So you tell your audit partner, and then you don't tell the board of directors, because some of those executives in A are also on the board. Right? Again, spooking the same sorts of people. But why would I tell the audit committee? What is special about the audit committee? Yes. So the audit committee must be made up of independent directors, non-executive directors, so that we know that they have less of an interest there. So ASA 240 actually specifies who we should do those communications with. All right. And it says, talk to the person on the job and then raise it with the audit committee, and you'll get some fraud specialists in. Who is doing FSA or has done FSA? So Dr. Anna Wright, who you guys have for FSA, is actually a fraud investigation specialist. So she's had the training in forensic accounting to go out and detect fraud. That was one of her specializations when she worked with one of the auditing firms. Okay, objective 4. Classify transactions and account balances into different sorts of cycles. So this is really taking the financial statements, income statement, balance sheet, cash flows, and dividing it up into reasonable transaction cycles. How do things happen within the firm? And we audit them separately. So the sorts of things that we might audit in a cycle: sales and collection. Now when it says collection there, it actually means we're actually collecting cash. Just in case you're a bit confused. Acquisition and payment, so that's buying stuff and then paying for it. Paying people, again with cash. Inventory, which sort of links to the acquisition, right? Those sort of go together because you've got to buy inventory unless you make it. And then capital acquisition, which is typically, what are the two forms of capital that companies have? They have equity, or they have debt. Yep. All right. So equity or debt, And then repayment, how do they repay their debts? They have interest, and then they have to pay back cash. So the one thing that you might notice here is a common theme. What's the common theme? Cash. So cash is the oil in the machine that keeps everything going. Without cash, to keep the organisation going, somebody said this word earlier, the company might not be solvent, so might be insolvent. So cash is really important, and cash pulls in at lots of different places. And this is why, even though we audit sales, the process of making a sale, so having the income statement item, then recording an accounts receivable, a balance sheet item, and then collecting cash, even though we have these different cycles, they're all linked together through the flow of cash. Okay. And we're actually going to learn how to audit most of these areas, but the ones we're going to focus on is going to be this one, sales and collection, buying stuff, and inventory. All right. Now, the reason I focus on those, and the one that we're going to start with that is actually going to be the sales one eventually, is because if you're going out to a graduate job as an auditor, the very first thing you will ever audit is either going to be sales, cash, or accounts receivable. That's where every single person starts. So I'm going to prepare you to do that. So how does the process work? We have all of our transactions. They get recorded into our ledgers, trial balance, and financial statements. This is basic accounting. You guys know all this, but I thought it would be good to refresh your memory. So, how exactly do I go about conducting my audit? My audit involves tests to gather evidence about the balances, all right, the transactions that go into each balance, and the balance itself. All right, so sales has, so if we look at sales throughout the year, sales has a whole lot of transactions and then some sort of total, that's the sum symbol if you forget your mathematics, that add up together at the end. So we're checking both the individual transactions and then that number at the end makes sense as well. And we want to do that for 3 different areas. And those different areas are transaction-related areas, which is anything to do with the income statement, that's the P&L. Balance-related objectives, most things related to the balance sheet. And then presentation and disclosure, which is really the entire financial report. All right. So we're going to learn about something called assertions. And this is a word that pretty much nobody has ever heard of before they get to audit. So this is a really key part. I'm going to harp on you about assertions for pretty much now until the end of term. So each week I'm going to remind you, we'll talk about this, and to the end you'll be like, Amanda, we get it, we understand. But what is an assertion? An assertion is a statement that one believes is true. Audit Junior is the cutest 3-year-old on the planet. That is my assertion. All right. Then, if I was having that audited, we would need to figure out whether that's true or not. Management do that when they put together the income statement, the balance sheet, the full financial report. They say, here are the documents. Here is our assertion of what we think is true, what we think, how the transactions should have been recorded throughout the year. So this is their version of truth. But how do we know if one number is true? All right, I love procedural crime drama. So, you know, your NCIS, CSI, Law and Order type shows. Sherlock as well, because that's a good deductive reasoning one. But in those, and if you watch NCIS, you'll know Gibbs, and he puts the suspect in that room, you know, and everybody else is watching behind the glass. He puts down the file and he's like, where were you on the night, blah, 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 blah. Stop lying to me. I can tell you're lying because, you know, we have this evidence. All right? But how do you do that to the financial statements? You can't exactly put the CEO or the CFO in an interrogation room and say, are you telling the truth? All right, this is not, was it A Few Good Men with Tom Cruise? And he goes, you can't handle the truth. And the paper doesn't talk back, right? I can't attach the financial statements to a lie detector test and say, okay, financial statements, is sales really $150 million for this year? And then you hear a little blip, oh, I think you're lying about that. All right? So there's no lie detector test for paper. And if you start talking to the financial statements and then the financial statements start talking back, that is the point at which you step away from the audit, because you've probably been working for like 18 hours straight and you're a little bit delirious if the evidence you're looking at starts talking back to you. But I need to figure out a way to determine whether the numbers are true and fair and free from material misstatement. So how exactly do I do that? I do that using something called financial statement assertions. All right, and I'm going to get to those on the next slide. Oh, the slide after this one. ASA 315 says that I must use assertions to determine whether there is a risk that an account is incorrect, and in designing my procedure that I'm going to use to actually collect my evidence. Whoops, my pen is not working. All right, so what exactly are these assertions? And my evidence, I'll just touch on this here, needs to be sufficient and appropriate. Sufficient refers to how much? And that's a really tricky question, because how much audit evidence is like how long is a piece of string? And then appropriate means the type of evidence, and we're going to get into that in future weeks, but just to introduce you to those concepts. So here are our assertions, and these actually come out of, I'm pretty sure, from memory, ASA 315, paragraph A124. I'll need to double check that with you, to be sure. But these are really self-explanatory terms. Now, these are for transactions. So this is really for things on my profit and loss. I want to make sure that every transaction really did occur. It happened. I've recorded all of my transactions. All right. Accuracy is about dollar value. I've recorded it at the correct amount. Classification, that's correct. That's not right. Whether transactions are recorded, there's an error there. Fix that. In the correct journal account. So when it says correct amount, it actually means recorded in the correct journal spot. Oh. Ah. Okay, that's what that's supposed to be there. And cut off whether transactions are recorded in the correct accounting period. All right, remember the prereq test, and I got you to look at that sales transaction and when it was delivered versus when it was paid for. So these are our assertions about transactions. I'm going to go over these every single week until you get it. And you're going to hate me by the end, because you will have got it. But these are really, really critical. These are what drive our audit. So I want to make sure every transaction really happened. I've recorded all of them at the correct dollar amount, the correct journal entry place, in the right period. Now these ones are for balances, which are things on the balance sheet. Right? It's a BS, short for balance sheet, not short for bullshit. And I use the word existence. Is my asset real? My liability? Do I see it? Do I know I can actually find it? All right, so existed. Completeness, whether I've got everything. Completeness is always characterized by the all word. Have I got all of my liabilities? Okay, this is most likely going to be a concern with liabilities, because people tend to understate their liabilities. So I worry about whether all of the liabilities are there. When it comes to existence, most people are likely to overstate their assets. Are there any fake assets, or are they all real? Valuation. Now, I'm going to break valuation and allocation into two bits. Valuation, the first bit, is about the dollar value, okay? And allocation is about whether it's in the correct spot on the financial statements. So that's sort of like saying, and I'm going to use the current, non-current sort of argument. Is my asset really a current asset or a non-current asset? And then the last one, rights and obligations. Do I have a right to recognise it? So we know that that usually comes from ownership or control, or whether I have an obligation to record a liability. All right, so these are the basics of accounting put into some specific audit terminology. Now, if you are an audit trainee or working at an audit firm, you may use different words than these to represent the same concepts. Some of the Big Four firms have taken these words and then given them new names so that they have proprietary audit methodology, their unique audit method, but everyone's doing the same thing. All right, these ones, presentation and disclosure, are about the actual report themselves. All right, so, and you'll notice these are often repeats. Did everything really happen? Is it real? Do I have to record it? Have I recorded everything in the correct dollar amount? So, classification, the only thing that's new, understandability. All right, so this is part of the readability of financial statements. If I'm looking at this, does it make sense? And really, what all of this is about is compliance with the AASBs. Is everything laid out in both the numbers and the note disclosures in accordance with the AASBs? Have they put in enough about related parties, about contingent liabilities? So I've put them together in a little table, and the reason I put transactions and balances is those are the ones we're going to focus on. Most times as a junior auditor, you won't be required to actually audit the disclosures in the annual report. So we don't spend too much time on P&D, but we do spend lots of time on these two areas. All right, and you'll notice that I've aligned them. So occurrence and existence are similar, but the reason we have different words is that I cannot say, does this table occur? You might if you're into sort of like an existential view of the world. Completeness is the same. Accuracy and valuation are the same, similar. Allocation and classification sort of go together, right? Is this in the right journal entry spot? Is this the correct non-current, current? Should it be an asset or an owner's equity item? The reason we use the word valuation instead of accuracy for balances is because valuation implies a more complicated process, all right? So sale, you record a sale, dollar value is nice and easy to see there. Valuation is something like an asset. It's a lot more complicated, so we use the word valuation to imply a more complicated process. And then cut-off and rights and obligations are fairly similar. Now, there is a video in the course documents area, and it's also on YouTube, where you can actually I'll go through a bigger, more detailed explanation of the assertions if you're not quite sure. All right, what are our objectives? Now, our objectives are really based on these assertions. And the only thing that's different, or that's extra, because timing is sort of like a cut-off thing, is this one. And this is really only a technicality of accounting, right? I want to make sure that the technicality of accounting worked correctly, but these are the key ones. Did my transaction happen? Did I record all of them at the right dollar value, in the right journal entry, in the right period? And then have all of those journal entries been posted and cross-posted to the right places, all right, and summarised correctly? Which, a lot of the time, the summarisation, I sort of pull back into the accuracy type area. All right, so there's some examples there. It's really, all you're doing is you're taking the assertion and then writing a sentence about it. Occurrence. Recorded sales are made to non-fictitious or real customers. All right, so designing an audit objective is really about taking the assertion and the account and then putting it together in a sentence. Not that hard, hopefully. The same for balances. So you'll see here our balances. Again, these ones. Oh, what have I got here? Okay. I'm just going to adjust because those aren't quite as. All right. Okay. So existence is the same. Completeness, valuation is really about have we got the right value for it. So let's go on to the. Oh, are we going to get the little? Oh, okay. All right. I'm missing a table, which you can look at in your textbook. Our presentation and disclosure objectives, we've got some specific objectives there, but it's really, I want to make sure everything complies with the AASBs, all right? Understandability, and all of this is disclosed in a way that matches that. We're not going to focus too much on P&D in our course. And then the relationship between objectives and our audit evidence. I have to have a plan. I just don't go out and go, oh, look, let me see what evidence I can see out in the wild, and I'm going to collect it and then make a decision. Instead, we have to have a plan, and that plan is called, all right, that plan is called an audit program, okay? And I will have programs for all of my different accounts. All of my accounts will have an audit program, or all of my transaction cycles, where I say, okay, for sales, I need to make sure that every sale really happened. I've recorded all of them at the correct amount in the correct period. It comes down to liability. All right, so we have our objectives, which are based around our assertions. We're going to learn how to collect evidence, and this is a design task. All right, this is something you guys are going to get to do. You're going to learn eventually how to design the audit plan. And everybody's plan is going to be different. And it's very possible that everybody's plan is still going to get full marks because there is more than one way to skin a cat. We're not going to be skinning cats. Or you could use other analogies. I like to use the analogy that audit programs are like fried rice. Obviously, I'm Chinese, and I come from a big family. And when we have family get-togethers, like we're going to have in a couple of weeks, all of my aunties bring fried rice. And you might think that seems stupid. Why would 6 of my aunties all bring fried rice to a family gathering? And it's because they all believe their fried rice is the best. And they're all different, all nutritious and yummy and well put together, but they all have their unique qualities because of different people's cooking methods. I have one auntie who's a bit of a health nut, so she makes her fried rice with brown rice. It's a bit chewy. So everybody has the ability to do this, and we're going to practice that. So how many subjects have you been creative in before you got to here? None? One? So here we're going to really learn to be creative and to be artistic. So that's really going to be the key moving forward. Shh, we're almost finished. Okay, 4 phases. Number 1, have a plan. All right, this is like the A-team. You've always got to have a plan. Perform the tests, and we're going to learn how to do this. Perform some analytics, and then complete and issue the audit report, like I talked about the reporting options earlier. So what we're going to spend a couple of weeks on is this bit, all right? And you might think, well, why are we going to spend 2 weeks on developing the plan? Because if you don't have a good plan, you might miss something. If you miss something, you might not find an error in the financial statements. If you don't find an error in the financial statements, you've given the wrong audit opinion. If you give the wrong audit opinion and the company collapses as a result of what you've done, you've exposed yourself to legal liability. So the reason that we spend a couple of weeks on planning before we move on to actually collecting evidence is for that particular reason. All right, key takeaways for today. Remember what the audit is all about, and ASA 200. Responsibilities for the auditor for detecting fraud versus error from ASA 240. And try and get a handle on the assertions. All right, thanks very much, everyone, and I will see you all next week. Please make sure you look at the video interview materials as well. Start preparing.